How Wall Street profits from student loans. Student loan asset-backed securities are a financial tool that allows Wall Street to profit handsomely from student loans. Student loan securitization is the process by which they are bundled and offered as financial assets to investors. In this video, we will go into detailed overview of how this system operates and its implications. Number 5. Securitization. The intricate financial process of securitization is essential to turning student loans into lucrative investment vehicles for Wall Street. Lenders, which might include banks, credit unions, and specialty student loan providers, start this process when they originate student loans for borrowers. When these lenders have amassed a sizable portfolio of loans, they group them together according to shared attributes like loan type, interest rates, and borrower credit profiles. Since the performance of the entire pool is typically more stable than that of any single loan, pooling of loans is essential because it reduces the risk of individual borrower defaults. A special purpose vehicle, a company established expressly to hold the assets and sell securities to investors, purchases the bundled loans. Asset-backed securities backed by student loans are subsequently issued by the SPV and offered for sale to institutional investors such as insurance companies, hedge funds, and pension funds. Investors receive returns over time from the cash flows created by borrower repayments, which include principal as well as interest. Lenders can offload risk and free up funds for further lending through the securitization process, which also produces a new asset class that diversifies investment portfolios. The capacity to turn illiquid loans into liquid securities improves market efficiency and expands access to educational funding, but it also gives rise to worries about profit being put ahead of borrower welfare. Number 4. Guaranteed returns. SLABS' appeal to investors is greatly increased by the government guarantees attached to many federal student loans, which act as a safety net to lower investment risk. The U.S. government backs federal student loans, including those made available through the Direct Loan Program. This implies that in the event of borrower default, the government will compensate lenders for a sizable amount of the money lost. For investors, this guarantee is especially significant because it reduces the overall risk profile of SLABS in comparison to other asset-backed securities that might not offer the same safeguards. For instance, under the Federal Family Education Loan Program, the government may return to lenders up to 97% of the loan balance in the event of default. Because they can count on the support of the government to minimize possible losses, institutional investors looking for steady, low-risk returns find SLABS appealing due to this degree of protection. Furthermore, by offering loans at reduced interest rates, lenders are able to increase the total volume of loans made possible by the existence of these guarantees. This combination produces a win-win situation where investors benefit from a reasonably safe investment that yields steady income and borrowers have access to the capital they need for education at more reasonable rates. Because these loans are guaranteed, SLABS cash flows are guaranteed to stay steady even during recessions, which makes them a popular option for conservative investors who value capital preservation as much as income generation. Number 3. Interest payments. The main source of income for SLABS investors is interest payments on student loans, which provides a steady and predictable source of income. Borrowers who take out student loans commit to repaying the principal plus interest over a predetermined period of time, which may be anywhere from 10 to 30 years. These loans have highly variable interest rates because of a number of variables, including the borrower's creditworthiness, the type of loan, federal versus private, and the state of the economy. Generally speaking, fixed interest rates on federal student loans are less expensive than those on private loans, which are subject to change depending on market conditions and the borrower's credit history. An interest component is added to each monthly payment made by borrowers, and this interest is then dispersed to the investors who own the SLABS. Because of the potential for large interest income, this structure not only guarantees a consistent income stream for investors, but also encourages lenders to keep making student loans. Additionally, investors can anticipate a consistent income stream for a considerable amount of time due to the lengthy repayment terms associated with student loans, which increases the allure of these securities. Since consistent payments are essential to preserving SLABS' value in the secondary market, the reliance on interest payments highlights the significance of borrower repayment behavior. Additionally, borrowers may face severe long-term financial burdens as a result of the interest accrued on their student loans, particularly if they find it difficult to make their payments on time. This may have an adverse effect on their financial stability and ability to move up the economic ladder. Number 2. Loan servicing. Wall Street makes a sizable profit from student loans through loan servicing, which is an essential part of the ecosystem surrounding student loans. The specialized businesses known as loan servicers are in charge of handling the financial aspects of student loans, such as payment collection and repayment plan advice. Because there are so many borrowers in the student loan system, these servicers can make a sizable profit by charging fees based on the volume of loans they manage. The fee schedule frequently encourages servicers to increase collections, which may result in actions that put financial gain ahead of the needs of borrowers. For example, even though repayment plans that optimize payments aren't the best for the borrower's financial circumstances, servicers might still push borrowers to sign up for them. Furthermore, because student loan repayment options can be confusing to borrowers, servicers may find it easier to charge fees or penalties for late payments or for borrowers who have difficulty navigating the repayment process. Due to this dynamic, borrowers may find themselves in a debt cycle where they must deal with progressively difficult financial circumstances, while servicers continue to make money from late fees and other charges. In addition, depending too much on servicers to oversee borrower relationships may result in uneven outcomes, with certain borrowers receiving insufficient assistance that worsens their financial circumstances. The way in which borrowers are treated is a major ethical concern arising from the implementation of this system, especially for those who are already at risk because of their financial situation. Number 1. Debt burden. Student loan debt has a profound effect on borrowers' lives and long-term financial stability that goes well beyond the financial markets. In the U.S., graduates with student loan debt typically owe $36,000. However, for those attending private schools or pursuing graduate degrees, this amount can be significantly higher. Long-term financial strain can result from this large debt since borrowers frequently have to balance their monthly loan payments with other living expenses like rent, utilities, and groceries. When people prioritize debt repayment over savings and investments, high levels of debt can cause them to postpone important life milestones like becoming a homeowner, getting married, and starting a family. Stress and anxiety are brought on by the strain of student loan debt as borrowers attempt to manage their financial obligations. In addition, student loans are distinct in that, even in situations of extreme financial difficulty, borrowers frequently have lifetime obligations due to the loan's infamously difficult discharge and bankruptcy. This exacerbates economic inequality by creating a debt cycle that disproportionately impacts people and communities with lower incomes. The ethical ramifications of making money off of education funding become increasingly apparent as Wall Street continues to profit from the student loan system. This raises concerns about the obligations of financial institutions to assist borrowers rather than prey on their vulnerabilities. The continuous discussion surrounding student loan reform and forgiveness emphasizes how urgently we need a more equitable system that puts borrowers' welfare first while allowing for sustainable financial practices. The negative effects of the current system highlight how critical it is to address the systemic problems that lead to the student debt crisis and to support laws that advance financial literacy, equal access to education, and borrower welfare-focused repayment plans. In summary, the securitization process, which converts individual debts into financial assets that generate returns for investors, is closely linked to Wall Street's profit from student loans. Although this system makes money accessible and liquid, it also keeps millions of Americans trapped in a debt cycle. If you liked our video, please hit the like button and subscribe to our YouTube channel.